Investors weigh the risk of a possible Russia default on debt and what that could actually mean for the broader financial system. Leslie Pickard joins us with the latest. Leslie, good morning.
Hey, Becky, good morning. Russia has about $117 million worth of interest payments due tomorrow to international bondholders. The question, though, is whether the Kremlin will pay and how. Russia's finance minister said it was, quote, fair for the country to pay in rubles while its reserves remain frozen due to sanctions. These bonds were issued in dollars without an option for the Kremlin to pay in local currency, and it might not be feasible given the sanctions to get rubles to bondholders anyway. So ratings agencies, bond investors, and the overall market is simply expecting Russia to miss its payment. But a hard default would not take place for another 30 days, a grace period accorded to a delinquent borrower. In the meantime, another big uncertainty surrounds credit default swaps, which pay out if Russia meets the technical term of a default, as decided by ISDA, the International Swaps and Derivatives Association. JP Morgan strategist wrote yesterday that, quote, as it stands, it looks like there will be a CDS trigger on Russian sovereign bonds, whether starting this week or later. Russia has about $20 billion in foreign currency bonds, while ruble-denominated bonds amount to $42 billion. There are also billions more in derivatives linked to a potential default. A U.S. Treasury official told Reuters overnight that they see limited direct exposure to Russian sovereign bonds within the U.S. financial system. The primary impact of all of this would be on Russia raising its future borrowing costs, guys.
Shepard Smith here. Thanks for watching CNBC on YouTube.